Hey everybody, this is Paul making a YouTube video. Today is July 30th. The market is obviously closed. It's a Saturday. So what I wanted to do is go over my portfolio performance going from July 15th until now, and then also go over some thoughts about where I think the market might be headed, that type of thing. Just, typical quick update. Um, so there's no other way to state it. July is easily my best month I've had since April of 2020. Even though the economic data is completely deteriorating. Just to give you a general idea, I haven't updated July quite yet. Um, I haven't updated July quite yet because it's still not technically August 1st. But as it stands right now, for the month of July, I've made $10,000.87. That's 23% portfolio increase. And my dividends have gone from 33.64 to 37.41. So the last time that I had a $10,000 one was right after I literally just got stimulus. It was basically after the government sent me a $5,600 stimulus because I have like two kids and a spouse and all that stuff. And then prior to that, I think I had a. This was long time ago. 20, like long time ago. It was like I think I took a loan or something like that, but I ended up with like a lot of debt. So right now I made that much, but I haven't increased my debt barely anything. So let's go over where all that came from. How much of that is market performance? How much of that is just tapping my credit? How much of that is just basically this little DoorDash thing that I kind of mentioned? Um, so as it stands right now, so this is the DoorDash money right here, $2,424.55. Um, DoorDash requires a lot of tracking. So right now, this is how much I've made with DoorDash. This is how much I've put so far into my account. I have a little thing right here that's tracking what percent that is. This is actually going to be higher because I haven't transferred my profits yet, and I'm still not done doing like shifts on Saturday and Sunday, which is actually the bigger paying days. So right now it stands at 78% of the profits have been deposited directly, literally into this account right here. That serves two purposes. So basically, that's non-tax money. So they don't tax that money up front. You get taxed on the back end at the end of the year, or you can pay it quarterly, or you can pay it weekly. I saw some people that were doing that. Um, what I'm doing is basically I'm piling that money into E-Trade so that I can get a return on it, or to my portfolio accounts, and I can get a return on it immediately between now and the end of the year. And then when tax time comes, I will either pay it out of the current money that I get, or I'll pay it just maybe sell shares or something. So I don't know. I'll figure that out closer to April 15th of 2023, but that's a long time away. So about 72% of this right here has been deposited directly into this account right here, into that account. So that accounts are part of the account balance. Another part of the account balance is something I just simply wasn't expecting. I've mentioned this before that I am a veteran, and I had appealed the decision that took my pay from 40 down to 10%. If you know anything about the VA, the difference between 40 and 10% is extremely dramatic. And so what happened was I wasn't expecting that to get resolved for years, which would have resulted in a lot of back pay, but it got resolved much quicker than I thought it was going to get resolved. I just checked it and it was like, oh yeah, this is resolved. And it took me a while to figure out even what they were going to pay me. But basically, it took the monthly from 152 up to 837, and this is completely tax free, by the way. Um, and also, they gave me back pay. So what did I do with the back pay? So what I when they deposited the back pay, I immediately transferred it over to here to my account, and I bought. I want to say Realty Income Core. I want to say I bought Realty Income Core with it, but I immediately transferred it over here. So the way that I try to do this is I try to treat this money like it doesn't exist because, as I stated, it went from 40 to 10%. It could easily go from 40 to 10% again. So I try to treat this money like it doesn't exist. So what this money has allowed me to do is right now there's a monthly dividend payment chart down here that I've shown multiple times. What I can do is I can still keep track of this, but what this allows me to do is it allows me to turn on dividend reinvesting for all of these stocks to build up these positions. Because one thing I've learned in the last few months is this worked up until about April or May. And if you know anything about what's going on around April or May, is a lot of energy companies across the country had to respond to the higher gas prices. So pretty much everything went up. So like if you were expecting to say pay, if your normal power bill was like $100, all of a sudden you got a $300 power bill. Um, there's some people that were paying. I saw one story of a lady who was paying $285 in April, and all of a sudden got her July bill, and it was $785. Now there could be all kinds of things going on there, but just to give you a general idea, there's a reason you see a lot of like older people, like people that were on fixed incomes. All of a sudden, you go to a McDonald's window, and all of a sudden there's a 70-year-old lady there. All of a sudden, that's because they're working part-time jobs. DoorDash, especially, the craziest thing is DoorDash. A lot of retirees doing it because it's set your own schedule. You don't report to anybody, and they actually already have a lower tax rate because they're older. So it actually works for them. It's kind of amazing how many like 60 plus year olds I see doing DoorDash, just kind of like a little side hustle. So that's where a good bit of the money came from. I did mention that I did take a loan in my last video, right there. So I did tap my credit. I have amazing credit, and I have almost no debt for being almost 40 years old. So I figured since I have an income source now, I have an income source with DoorDash stuff. It's easy. That doesn't even remotely affect me. So definitely going to definitely keep track of this part down here, how much dividends I have coming in. I'm going to end up adding this back in. This will probably end up being something like this right here, AFB, and then it'll end up being whatever that amount is. And then we could throw it like that or something. But I'll end up adding that back in just because I think that makes sense. I think my gas bill this time around was like 38, so my goal is to get this up to 38. So I will be adding to this AFB position. This is that municipal bond fund. So if at some point you see this say $10,000, that's $10,000 completely tax free whenever it pays its monthly dividend. So you can kind of see what the payout is. It's 4 cents per share, and it costs $11.90. If you're cautious about investing, you're looking for a place just to kind of start out, I always recommend these municipal bond mutual funds. AFB is just one example. Believe in my other portfolio here, GYIRX, that's another one. I have AFB in this other portfolio here too, but that's just it's just a municipal bond fund. It's just has municipal bonds from all over the country, every state. They have a portfolio breakdown, so that's a good place. I just pile money in, and then this dividend that pays out every month is completely tax free. Now, if I bought the stock and the stock went higher than what I originally bought it for, that's a capital gains tax. So you will get taxed on that. But the monthly dividend that pays out is completely tax free. And I've been doing this for multiple years with these types of funds. This is how I originally started out. I originally had a portfolio that was 100% municipal bonds until I felt comfortable kind of dipping my foot into stocks. But so if you're looking for just quick tax-free income, that's just a perfect example right here if you have access to it. Each brokerage has tons of these little funds that you can get into. Most of them are pretty safe. Just be careful what you're investing in. Just make sure you don't buy if you find one of these that's super cheap and it has a super high payout, it probably has a bunch of municipal debt from like Puerto Rico or something, somebody that might actually default on their debt. So you want to kind of like look through it and see what state it has exposure to. Some of them are very state specific. There's one that's literally, this right here, this one, FQLAX, for example, Franklin, Louisiana tax-free income. This is literally Louisiana debt, Louisiana municipal bond debt that voters approve. So this is specifically exposure to Louisiana. So this little 38 cents I get every month right here that gets redeposited, that's Louisiana debt. So what I've done, since I have that VA check coming in now, what that's done is I've turned on dividend reinvesting for this entire section of my portfolio to start building up these positions. I want to probably, before I ever consider retirement again, probably double this number double these numbers right here, which at this rate is going to be pretty easy. Um, so that's where we're at right now in the portfolio. So the loan, large amount of the DoorDash money, back pay from the VA, which was about $1,400, and then also just a ridiculous market performance for the month, just ridiculous. Um, 5.63% alone, 10% on the Nasdaq, and that'll lead me into where I kind of think this is going. Um, so as you can see, just basically I have a huge market performance for the month, just absolutely ridiculous. You can kind of see just this big, huge line. You can see it right there. So started the month at below 40,000, now about to break 50,000 in this portfolio again. Um, so that's just basically piling profits in. It's just a large pile of money. It just came from different sources. Also, one strange thing, I left my old employer in January, and they don't pay out their 401k until July. They were paid out their 401k contribution once a year. Apparently, didn't even know. They sent me a letter saying that I had money sitting in an old 401k account. And I'm like, I thought I cashed that out. And that's another source of basically like $1,000. Because I had to cash it out, or I had to like basically start rolling it over in Vanguard, and they were going to charge me fees. I was like, that's not going to happen. And I could have rolled that over into my IRA, but whatever. It's just it gives me a way to pay taxes on something, so I can lower the amount that I probably owe on DoorDash at the end of the year. So it shows that I'm paying taxes or whatever. And then also I can just pile the money back in here. So that's another source of income. So there's been just various sources of income in July that just some were expected, like DoorDash and whatever. But back pay from the VA, that type of stuff. Pay from like a contribution from an employer I'm not even with anymore. That was just random money that just got dropped in there. So where are we at in market performance right now? Where are we at? Where do I think we're going? All right, so basically you can kind of see we started the year flat. Some people started selling at the beginning of the year because they knew that the Federal Reserve had changed their tune. And then if you kind of take it out 1 year, we can do this at this point. You can kind of see that the market had started to price in like the Federal Reserve being more tight, but the Federal Reserve was still doing something called guidance at the time. This is where they guided forward. They said, okay, we're going to hike 25% this time, but we don't think in the future we need to do this anymore. We think everything's under control. Well, as things became obviously out of control, you can kind of see what happened. The market was like, the market repriced for higher rates, but then they were like, oh, guidance says that, they're not going to have to go as high, so the market kind of rebounded a little. Oh, next Fed meeting. Oh, turns out inflation is still really bad, And then the market was like, oh, we need to reprice. So it's been a bunch of repricing based on what the Fed's saying. We're still in there. Right now, the Federal Reserve thinks they're at what's called neutral. What neutral is basically where they think that the 2 year is just, you can call it a Goldilocks zone, you can call it whatever you want, but they think that this amount right here is kind of like a good spot for the 2 year to be, that they control. It's like the Goldilocks. It's not too tight, it's not too loose, financial conditions are just perfect. But that's not how this is actually working. So what happens is when you tell that to the market, and they said 3 times that they thought they were at neutral. Powell did in his Federal Reserve chairman in his press conference. So the market interpreted that as, well, if he's saying we're hit this target, are they done? Plus they're not doing guidance anymore, and we don't have to hear from them in August because they take a month break, because of course they do. So the next time you're going to hear from the Federal Reserve is in September something, like September 15th. There's a lot of data that comes in between now and then that's actually going to be able to feed through the economy. They're going to take a break from raising rates. So the market took that as, rocket liftoff, it's time to take the rocket ship up. And you can literally see, this literal just straight line up. So, what is like, where do we go from here? Like, what happens now? So as you can see, we kind of took these different things. We had effectively bear market rallies in here. Earnings have come in not amazing, beating or whatever, but some of the companies that need to beat, the ones that really drive this market, came out like Apple, Amazon, Google. They really came out swinging, and the bears had no defense. So everybody was very ultra like held in puts, which means that they thought the market was going to go down. And then all of a sudden you get a 1-2 combo to those guys. So the Federal Reserve comes out and says, "Yeah, we think we're at neutral. We're going to kind of get rid of guidance. We're going to see where it goes from here," which could mean we pause. Okay. Then in the very next day, you get Amazon and Apple that report and say, "Yeah, we're doing pretty good. The consumer's not nearly as bad as y'all think it is," and that just basically just kicked the bears right in the private areas. So that's why we're up. It's two things. Now here's where this completely backfires, or here's where this is not. I still think 100%. Like if any money that you put up to work right now might be down 15% by the end of the year. Why do I say that? That would be because mortgages are just utterly tanking. There's a few YouTube channels. Just be careful. Some YouTube channels are just posting like doom, it's doom, everything's collapsing. I went through a collapse in Phoenix, Arizona in 2008. This is not that. This is one hell of a slowdown. This is an extreme slowdown, but this isn't a collapse. A collapse is when people are just losing their houses and they're forced to move out because they can't pay their mortgages anymore. What this is a bunch of people trying to sell their houses, and the housing market is effectively grinding to a halt. The problem there is that that has been a very big recession indicator. Um, so jobless claims haven't, like jobless claims haven't ticked up like the bears said they were going to tick up. Like that just hasn't happened. We get those every week. They're kind of up, but they're still at historic lows. The jobless rate hasn't ticked up. That's still at historic lows. We think we just added like 200,000 jobs or something like that. So the numbers, it's it's very confusing if you're a bear right now because this is the GDP report. So if you look at the GDP report, everybody's saying, okay, two negative quarters, we should be in a recession. The market should be pricing in 20% lower. Like this market should, without a doubt, not be here. This 4130 right now should be 3200 according to a lot of people that were like thinking this market was just going to go down in a straight line. The problem is we're in extraordinary times. So you have businesses that were 1 year late to the party. Stimulus checks for everybody, not the ones that they got sent. Like stimulus checks for people that had kids. That extra $550 a month that we were getting, I think I even had that on here. This right here, see this right here? That stopped in Q4 2021. So they built up there was a bunch of demand in the system, but there wasn't enough supply. Well, so what happened is that businesses did what businesses do. They said, okay, well, we have this bunch of demand now. They didn't think that it would slow down, but it should have been obvious it was going to slow down, but it's kind of not obvious because they thought, oh, well, the Democrats are just going to pass another bill and there's going to be more stimulus into the economy. The problem is that everybody, like government spending effectively stopped. And then you can kind of see like government spending is barely anything at all. Um, it's just the normal stuff, but it's almost negative at this point. Like government spending was actually negative. It was actually a detriment to the economy. You see right here. Also, we have a Federal Reserve that's raising rates at the exact same time that Europe is going into a brutal recession caused by energy. China is doing massive lockdown still. Russia is not even a player anymore on the global scale. India, I haven't really heard anything from them, but they're an export-driven economy and they export to us. Well, the problem is that their rupee has been massively devalued because our dollar is extremely strong. So you see the problem. So they're kind of we're kind of having a problem right now. So you see a lot of companies complaining about the value of the dollar, which is extremely high right now. Um, if you go right here to this, you can kind of see. but the value of the dollar, USD index, sitting at a 105.83. This is actually a little bit lower, and you can see it went down by a lot, but because the market is pricing out rate cuts because of what Powell said. Oh, we might have to raise anymore. But this was sitting at a 107, almost a 108, which is just ridiculously high. So the problem is right now is if we get to September 15th, like say the market does really good between now and September 15th. If the data is still showing that inflation is hot between now and September 15th, this market is going to go straight down. We might test 3,800 again very, 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 very easily. And if the data comes in extremely hot, so if you get to September and you're still seeing 9% inflation reports, I don't see how we don't go back down to this right here, to this 3,600 level on the S&P where we were. I don't see how we don't go down to like this area right here. If you get to, so it depends on what the data between now and September 15th says. If we get to September 15th and inflation has been cut in half and it's very obvious that it's going down in a straight line and everything's great, there you go. But if we get to September 15th and inflation's still at 9%, the Federal Reserve is going to raise another 75 basis point. And that's above neutral, where they stay neutrals at. So you're going to see this take off, this go down by a lot. These two are going to invert without a doubt. The 10-year is going to go through the 3-month, which is like check mark on your recession coming within 2 months. If you see the 10-year cut through the 3-month right here, that's recession 101. That's recession within 2 to 3 months. That's been your best predictor pretty much out of anything that's getting thrown at the screen right now. And you'll see the USD just shoot up like a rocket. I wouldn't be shocked if this goes up to 108, 109 again. Like this would just shoot up like a rocket because at that point we have more data out of Europe showing that Europe's in a brutal recession. We would just have more data out of everywhere. You would have more data out of China. Unless they do some massive stimulus to contain their economy, you would have just brutal things. So you would just have all the ingredients for like a pretty rough recession. And that's when the job layoffs start. They'll hike us into a recession, I have a feeling. And then what happens after September? Well, all of a sudden you get to October, which is a famous month for market crashes. Markets love to crash in October. What if you get to October, you still have 9% inflation? So not only are you through neutral now with 75 basis points, with another 75 in September, because they'll do it, what happens if they do another 50 in October? And this is the problem. This is how they hike us into a recession. So the conditions are already very tight. The housing market is telling you, hey, you need to back off. But that's kind of how you get the negative 15% scenario. And at this point, because it's up 5%, it might end up being negative 20%. So just be aware, any money that you put to work now could very, very, very easily be down 20%, 15 to 20% by the end of the year. So that's a warning that I have to keep giving in my videos, is that nothing's set in stone right now, and it all depends on what inflation does and what the Fed does. But if we get to September, if we get to September and inflation is clearly just like, cut in half and everything's great and everything's going great, then, if everything's going great, the market just takes off like a rocket ship, because then they're going to start pricing in looser market conditions, like they're just going to start pricing in just looser conditions. It's not going to be as tight. It's entirely possible we get a 25% basis point. But I think 25 without a doubt is on the table come September. I just don't see how they stop unless the data just utterly collapses and jobless claims go through the roof. I see. That seems to be the only thing that they're watching right now is jobless claims or jobless report. If they start to see the unemployment rate start to tick up by like a lot, they'll slow down and ease. But until you see that happen, you're not getting relief on rates anytime soon. But the problem is by the time that you see companies starting to do $200,000 a month unemployed, $400,000 or $400,000 a month unemployed, it's too late. The economy is already going into a tailspin at that point. They can't stand in front of that. Once they push that boulder over that cliff, they can't stand in front of it. It has to basically hit the bottom of the cliff, and then they can do the easy rate stuff. So Our economy literally depends on whatever 10 people or whatever voting on the Federal Reserve right now, which is extremely stupid. I really, really hate it. But that's kind of where we're at right now. So it really depends on the inflation reports. Like I said, this number could very, very easily. So right now, whenever I add to a position, just so that you know how I'm adding, is what I do is I'm trying to add to positions that are beat up. So for example, Intel is a perfect example of this. Intel basically just got $52 billion injected into them. The government just effectively agreed to subsidize their profits for the next like 10 or 20 years or something like that to bring their chip manufacturing facilities back to the US. So when we finally do come out of this, I think Intel is actually going to be a pretty decent stock. I wouldn't put everything in it, obviously, maybe like a 2% position or something, but it has a dividend that's coming up. Procter and Gamble, this one that's sold off 6%. Like, I mean, come on, it's Procter and Gamble. Are you serious right now? Like, literally everything in Target's made by them. Kimberly Clark, any of these consumer. So if we go into a recession, consumer discretionary is going to be the place to be. People that sell stuff that people have to buy. Kimberly Clark, Procter and Gamble, um, Walmart. This is one that this this was such an easy buy. Like this was I posted about this on Twitter. If you think we're going into a recession and this stock dumps down to where did I buy it at? You see right here. This is where I use that 401k money. Look at that. I made 8.5% or 8.75% off of that. Quick 74 bucks. It went down to 121. Like, are you kidding me? It's Walmart. It's like the biggest thing in the country. So, what I recommend is just basically be careful where you're adding to right now because this could all very, 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 very quickly reverse. This could go back to 10,000 very quickly. This can go back down to 3,800 very quickly. This can go back to 29,000 very quickly. And I mean very quickly. If you look at the VIX, this could go up to 32, 34 very quickly. There's just certain things that can happen very quickly. Um, so just be careful where you're investing. So that's where we're at right now. I'll be sure to upload this here in a second so that y'all have access to it. And then there you go. Sorry this was kind of long. How long was this? Oh God, 27 minutes. But yeah, just let me know what you think in the comments. If you watched the end, hey, you're awesome. Thank you so much. Have a nice day.